do you know? BlackRock's did a $23 billion global port acquisition, a strategic power play. In a landmark deal, BlackRock, the world's largest asset manager, has acquired 43 strategic ports worldwide, including 2 in Panama, in a massive $23 billion transaction. This acquisition is not just a business expansion, but a move that reshapes global trade, geopolitics, and economic influence. Why did BlackRock make a $23 billion global port acquisition? BlackRock's interest in ports is driven by multiple factors. Stable, recurring revenue. Ports generate consistent income through cargo handling fees, making them attractive long-term investments. Control over global trade routes. With ownership of key ports, BlackRock gains leverage over global supply chains, potentially dictating shipping costs and trade policies. Alignment with U.S. strategic interests. Former President Donald Trump's economic policies focus on securing critical global assets. This acquisition aligns with U.S. interests in countering foreign influence, particularly China's Belt and Road Initiative, BRI. Growing infrastructure investment. As markets remain volatile, BlackRock is diversifying into stable infrastructure assets that promise long-term returns. What impact does $23 billion global port acquisition on the U.S. economy? For the United States, BlackRock's acquisition is both an economic and strategic victory. Strengthens U.S. global trade control. With BlackRock in charge of these ports, the U.S. gains indirect control over global shipping routes, reducing reliance on China-controlled ports. Job creation and economic growth. Investments in logistics and port operations will likely boost employment and business opportunities. Enhances U.S. dollar dominance. If BlackRock prices port services in USD, it could reinforce the dollar's global influence. Risk of higher shipping costs. If BlackRock raises port tariffs, importers and exporters could face higher logistics expenses, potentially leading to inflation in traded goods. Regulatory hurdles. Some countries may push back against U.S. private ownership of their strategic trade hubs, leading to disputes. Can you imagine the impact of BlackRock's $23 billion global port acquisition on global economic and geopolitical impact? BlackRock's acquisition sends shockwaves through global trade and power dynamics. A challenge to China's Belt and Road Initiative, BRI. China has invested heavily in ports worldwide, but BlackRock's move gives the U.S. a counterweight, limiting Beijing's ability to dominate global shipping. Potential market disruptions. If BlackRock alters pricing structures, competitors like China's Costco and Dubai's DP World might react with lower fees, triggering a global price war in port operations. Shift in trade routes. Countries dependent on these ports may have to restructure their logistics strategies, especially if U.S. policies influence BlackRock's operations. Does global superpowers like India, China, and Russia should worry about BlackRock's $23 billion global port acquisition? China. This deal directly challenges China's dominance in global trade. If BlackRock prioritizes U.S. allied nations or increases fees for China-linked cargo, it could disrupt Chinese exports and raise their trade costs. India. India is expanding its domestic port infrastructure, but it still depends on international shipping lanes. If BlackRock increases trade costs, India's exports could become more expensive. However, efficiency gains in logistics may partially offset this. Russia. Since Russia relies on global shipping to export oil, gas, and commodities, any new U.S. aligned trade restrictions from BlackRock-controlled ports could hamper Russia's trade routes, adding pressure to an already sanctioned economy.